Today, folks, if you are Canadian, arguably the two most important things you will ever do in your personal finance is max out your TFSA, the tax-free savings account, which allows you to take your earned income, you put it in this account, you can generate dividends and capital gains tax-free in perpetuity for the rest of your life. Oh man, it's such a beautiful thing. You can draw those dividends and capital gains whenever you want, and it doesn't even affect your income tax bracket. The second account, your registered retirement savings plan, your RRSP. When you earn income, you do have to pay tax on that income, but the government says, hey, if you put that money in the RRSP, we'll waive any taxes that you'd have to pay on that money today, at which we will allow you to earn capital gains and dividends tax-free in perpetuity until you pull that money out, at which we're just going to tax you at your regular income tax rate. Both of these accounts combined, if you use them correctly, can turn you very quickly into a Canadian millionaire. And I want to share with you what I currently hold in both of these accounts, my feelings around it, my short-term and long-term plans with the stocks in there. So if you are on a path to financial independence, if you damn well one day want to retire early and you find this content resonates with you, let's do this journey together by simply hitting that subscribe button. Currently in my tax-free savings account, guys, I have about $164,000. I'm up about $16,000, but you might recall if you're OG, I utilized the money I had in this account. I drew all of it out to purchase a piece of real estate, a condo here in Toronto, and that was just almost 2 years ago, at which I've been really aggressively building this account back. And currently, if we take a look at the holdings in here, we'll start with the safer ETFs. I have VDY till I mother friggin' die. This is my monthly paying Canadian dividend ETF. I currently own 1,197 shares at an average cost of $46.41. Currently up about 10%. This ETF right now yields around 4%, but they just did a really large dividend payment. It was a record high dividend payment. We can see they paid out about 23 cents as it is a monthly paying ETF, which I like a lot. And if we take a look at the dividend growth rate, it's also very nice. It's about 8.78%. This is the 5-year growth rate on average annually. You're not really complaining at these growth rates overall, and that's because the holdings are pretty concentrated in the best Canadian dividend stocks, primarily the banks. As we take a look at the financial sector exposure, it makes up 53%, so you are largely exposed to things like Royal Bank, Toronto Dominion, Bank of Montreal, Bank of Nova Scotia, but you do get the energy stocks in here like Enbridge, Manulife's in here. There's a lot of great companies in here, including the telecom giants, but I do like the heavier exposure to the banks because, like Pokemon cards, you got to collect them all, and I would buy these individually, so I like how they weight. It's a market cap weighted ETF, so if these things do come and go out of favor, I don't have to worry about management making the decision. Just based on the size of the company itself, if it gets smaller, it will automatically get a smaller positioning in this ETF. But again, it is concentrated. So if Royal Bank got hit really heavy for whatever reason and it dropped, say 50%, this ETF would drop 6% very quickly, and it is something you need to be aware of, which is why I don't want it to be an overlappingly huge position in the portfolio. I think I'll max it at about 75K, and then I'll probably start looking at some other global market ETFs just to continue diversifying, which leads me into the second ETF that many of you are aware of, the S&P 500's VOO. And keep in mind, I do have my currencies separated, so when I'm showing you the Canadian positions, that is in Canadian dollars. When I'm showing you these US positions, they are actually in a US dollar position account. So they're all under the TFSA, but I have Canadian and US dollar accounts. And this has about $44,000 in value. I'm up about 16%. I have 80 shares currently with an average buy of $474.98. I do love the S&P 500. It is one of my favorite investments, and I actually sold it off to buy some individual positions in my TFSA, which we'll talk about in a moment. But we did a really good job cost averaging through this slump, the tariff war. And this really worked to our favor, and now we're seeing those gains really come into play here, which is just awesome. And this also being a market cap weighted ETF makes me a little bit more alleviated of any overvaluation fears, because if the market's overvalued and these things start to correct, there will be companies that don't correct as much, and they'll start balancing themselves out based on the market cap, right? But I love the exposure to Apple, Microsoft, NVIDIA, Amazon, Meta, Google. These are companies, again, that I would own on an individual basis, with the exception of a few. Like, I'm not the biggest fan of Tesla, let's say, right now at its current value, but even still, if that stock holds its hype and continues to rally, it doesn't matter how I feel about it, the size of the company will debate on how big of a position it gets in this ETF, which is why I love Vanguard and I love market cap weighted ETFs. Now, don't get me wrong, I am a speculator. I do like owning individual stocks, and I have excelled at this over the last decade, and I'm still trying to get outsized returns by positioning Some stocks that I think are trading at better values that could, quickly regain some value in shorter periods of time. And Google's one of those. I have 66 shares of Google in here, and Google has become my largest position overall. I do have Google spread across multiple accounts in my corporation. My fiance owns a lot of it. So keep in mind that these positions are quite scattered and they scale differently depending on the accounts. But I got 66 shares of Google at $172.70 in my TFSA. I'm only up 1%. I'm now break even because Google has started to rally. And I've been cost averaging in this throughout the last year. And I think I've got a good buy price. I think Google deserves about a 25 to 30 times multiple. If we do get back up there in a relative short period of time, I will scale this position down quite materially, but I do look at this as a relative long-term hold. I do like Google stock. Now, Take-Two Interactive makes me a bit uneasy right now because I didn't plan on holding this for much more than the end of this year, 2025, because I was buying Take-Two, the parent company to Rockstar Games, a video game company that is going to be releasing Grand Theft Auto 6. And I think this is the most valued piece of media ever. We've talked about how it has cost more than the Burj Khalifa and is taking longer to build than the Burj Khalifa. And I think it's going to bring ungodly amounts of money when it drops to this company, and the hype alone should continue to rally the stock. So I currently have 82 shares, average price of $212. I'm up 9.8%. It's a pretty sizable position overall. And if we take a look, we bought this right after the first rally kind of came in after earnings here. But again, you got to keep in mind, guys, I'm very much speculating on this. I'm not comfortable with it being in my TFSA at the size that it is, but because of the institutional ownership makes up like 95% of the total shares outstanding, it's been a very stable stock. And what I should have done is during the April tariff crash, the stock barely dropped at all, whereas the S&P dropped quite materially. And if I was smart, I should have sold this and really just bought up the dip right around here, because I would have been up, sizably almost 20% if I just did that when I was looking at the S&P dropping so aggressively. So I'm still crossing my fingers that we can see outsized returns as we approach GTA 6 in 2026. But I have to be patient here, and depending on how long I plan on holding this for will be debatable. But Google and Take-Two right now, between all of the combined accounts, are the largest single stock positions I've ever taken in my career. Both are worth 35 to 40K in total value, but this is just what sits in my TFSA. Now, moving on to my registered retirement savings plan. Currently worth 110,000. I'm up 10K in here, and I did some major moves this year. In my RRSP, I actually made a really big speculation early on. Back in 2019, I bought Tesla stock, and Tesla went to the moon. I sold off my entire Tesla position, thinking I'd be more conservative. I put it into the Schwab US Dividend Equity ETF. Now, this was a big mistake in my opinion, because Schwab has done absolutely nothing, as has Tesla stock. Tesla stock has kind of peaked back in 2021, and it's been kind of very volatile, but hasn't really gone up a whole lot more or down a whole lot more. And neither has SCHD. And I kind of got tired of this because I didn't like the management's decision making around what the holdings were in this ETF. And I think they're great holdings. I just don't think they have a lot of growth in the near term or in the midterm. It's just a great place to park some money and get some cash flow, which I personally don't need the cash flow today, so why would I worry about it? And I actually sold SCHD on April 28th. If I held this position, I would have been up another 4.77%. But instead, what I did on April 28th is I took this position entirely and I pivoted most of it into the S&P 500, at which we can see is up 9.58% since I made that decision. And we can actually see that right here as I bought 125 shares at $502, and we're up 10.38%. So favorably, this was a much more intelligent decision, at which I also bought some Take-Two Interactive. And I'm actually up 12% because I got in here at about $208, 32 shares. So my RSP, I'm actually excelling well beyond where I would have been if I just stuck with SCHD. And I pat myself on the back, but this is a much shorter term perspective, and these positions can change at any time. Again, it's not financial advice. Got to pay attention to what's going on here. And we'll see how this, pans out over time. But I am happy that I pivoted, and I recognize that it was time to pivot. And even in this short 2-month time span, it is working materially out to my favor. Now, finally, the last stock I hold, and one that over time I will start scaling for wealth preservation. Over time, I don't consider myself too much of a speculator these days. I'm not really buying a whole lot of speculative stocks like I used to be. Once upon a time, my entire portfolio was individual stocks. But as I age, as my wealth scales, I'm not really looking at owning a whole variety of 20 or 30 stocks. As I told you, my goal is to focus on the many, or sorry, cost average into the many and focus on the few. And what I mean by that is cost average into the indexes and pick a handful of stocks that you like, that you think you can excel with, but don't make them much more than 10 or 20% of your portfolio, depending on your risk tolerance and your age. And as you make profit on those stocks, scale them down and put them into long-term investment vehicles like XEQT. And that's what I'm looking to do with these stocks. If these stocks materially continue to work out in the next year or two, I will scale them down. I will take that money, and I want to make XEQT a much more sizable position between all of my accounts. Currently, only in my RRSP, I hold XEQT 152 shares at an average of 33.69, and I'm up, 3.73%. These are not exciting investment vehicles, but they do offer fairly healthy long-term rates of return, and give you exposure to the global market to continue to help me diversify away from just the S&P 500 and the Canadian markets. But I'm very happy, I'd be very happy being fully exposed to the S&P, and it's why I'm so heavily concentrated in the US right now, because I still think that's where most of the outsized returns are going to come from. But as I max these accounts out, and in the next 2 years, I told you guys I want to reach financial independence, get the mortgage paid off, get these accounts fully maxed out, and just fully diversify them. And again, I might still speculate on some individual positions, but the overall goal is to make sure that the wealth preservation, our futures are guaranteed in the safest and path of least resistant investment vehicles, being these ETFs specifically. So, that's kind of the long-term vision here and the short-term vision. And I hope I offered enough clarity on how I feel about my TFSA and my RRSP. Some things I don't like is the overconcentration and perhaps Take Two Interactive. We'll see if that works to my favor or not. If it detriments me, you're going to find out what the risk is, concentrating individual stocks in these accounts. But if it works out, great. I can take those profits. You'll see me diversify, and you can subscribe to see how all of that unfolds. And if you want to join my chat group or talk with me one-on-one, consider going to kylelivingston.com. Link is in the description below. But I'll pass the question off to you. I'd love to know what you think about all of this in that comment section.